It's time to do business. Welcome to Business Incorporated, where we do 55 minutes of a journey around the world of business. And on the program today, here's what we have prepared for you. Nigeria is expecting inflation numbers for February, waiting on the NBS, and hopefully we will get it before the business ends. It's affecting everybody. The OECD has cut economic outlook for major economies globally. And Ghana has endorsed Solana. Of course, you expect what that will do to the prices. Good afternoon, everyone. I'm John Mekwa. Let's do business. We'll start from the global space as usual. In the metal space, gold firm on Monday after touching a historic milestone last week. That happened on Friday, but before the close of trade on Friday, we saw that it tapered back to less than $3,000, which is the record high that it has hit now for today. We see spot gold is up 0.1% at $2,986.53 per ounce, and bullion rose above 3,000 on Friday. That's, is that record high that we talked about. U.S. gold futures eased 0.2%, $2,994.60. The recent rally in gold has been driven by stagflationary fears that short-term momentum remains positive, with the next intermediate resistance at $3,016 or $3,030. U.S. consumer sentiment plunged to nearly 2.5-year low in March, and inflation expectations soared amidst worries that President Donald Trump's sweeping tariff, would ignite a trade war. Geopolitical tensions are also there, feeding on the investors' sentiment at this time. Spot silver shed 0.1% to $33.76 per ounce. Platinum added 0.1% to $994.50. Palladium eased 0.1% to $963.63 per ounce. Still in the global space, we're looking at oil now, when we see that oil traded high on Monday after the United States vowed to keep attacking Yemen Houthis until the Iran-aligned group ends its assault on shipping and Chinese economic data. That also fueled hopes for higher demand. U.S. President Donald Trump had launched military strikes against the Houthis on Saturday over the group's attacks against Red Sea shipping. And Brent, we see, gained 72 cents. That's about 1% to $71.30. And WTI also gained almost 1% at 0.9%, at 0.9 to $67.77 a barrel. Oil prices are benefiting from better than expected Chinese economic data we talked about earlier today, and it's because of the stimulus that the Chinese government has been releasing into the economy. They have a new one which they started over the weekend. We'll see how much impact that will also have on the economy, and of course it will spill over to oil prices globally. Now we come to Nigeria and see that latest data from the Central Bank of Nigeria shows that direct remittance inflows into the country stood at $1.92 billion at the end of 2024. This amount reflects a slight decline from the $1.98 billion recorded in the previous year. Despite the drop, remittances continues to play a critical role in supporting household income and foreign exchange liquidity. The data also reveals that January and February 2025 have already recorded $180 million in direct remittances, with $125.6 million in January and $54.4 million in February, while a modest recovery is recorded so far this month, that's March, with remittances rising to $104.9 million, signaling a gradual stabilization in that area. The Asset Management Corporation of Nigeria, AMCON, says over 2.1 trillion naira has been recovered in debtors so far from those under its watch. In a statement released to journalists by the agency's head of corporate communications, Mr. Jude Nwanzo, AMCON says the amounts retrieved comes despite its challenges since inception. He also mentions that AMCON currently has over 2,000 cases in court, as some of the corporation's debtors owe nearly 5 trillion naira. Meanwhile, AMCON has reaffirmed its commitment to recovering the 227.6 billion naira owed by Arik Air Limited, which in its receivership and its founder, Mr. Johnson Arumeme Ikede, amid ongoing legal battles and allegations of mismanagement. Now, there will be zero tolerance for investments that do not comply with regulations of the Securities and Exchange Commission in 2025. This is according to Director General of the Capital Market Regulator, Mr. Emotimi Agama. Speaking earlier today on Business Morning, Mr. Agama highlights that compliance, collaboration and disclosure are critical for the protection of investors, which remains at the front burner of its mandate this year.
So the year 2025 is a year where we will say that there is zero tolerance for any activity that does not fall within the laws of the Investment and Securities Act 2007. I'm sure it will interest you to note that the National Assembly has passed the new Investment and Securities Act. We are earnestly waiting for the president's assent as it's going through administrative process to get to the president to get it assented to. And that alone also signifies our intention to make sure that everyone that is investing in this market or intends to invest in this market has a cover. That cover runs across so many lines. Particularly, let me mention that Ponzi schemes will no longer be a place where people will be fettering, where people will be interested in, because the penalties in the new ISA, towards people that are engaged in Ponzi scheme is stiff enough to deter them. But beyond all of that, we're emphasizing that compliance is important and disclosure is also important, being the cardinal objectives of securities regulation. And so everyone that is in this market intends to be in this market and will want to collaborate with us in developing the market.
Now, the Central Securities Clearing System, PLC, CSCS, is set to host the Africa and Middle East Depositors Association, AMIDA, annual conference. The highly anticipated event is expected to hold from April 23rd to 25th in Lagos with the theme, Shaping the Future, Financial Markets and Infrastructures as Catalysts for Transforming Economies. Key financial market stakeholders, industry leaders and policymakers from across the continent and the Middle East are expected to convene on the conference to discuss the evolving landscape of financial markets, infrastructure, and its role in economic transformation. The AMIDA conference has long been recognized as a premier platform for fostering collaboration among central securities depositories and clearing houses in the region. As consumer and retail activities in the country undergo rapid changes, several key trends are expected to shape the landscape this year. An academic director in the Africa Retail Academy of the Lagos Business School, Professor Uchenna Uzo, who was a guest on Business Morning earlier today, listed 3 major trends that could lead to the trends shift by retailers and consumers in 2025.
We've had consumers with more empty pockets than before. We hear of rebased inflation, but our pockets haven't been rebased. We've had a lot more brand disloyalty than ever before, and a couple of other things. In fact, I like to say that the Nigerian consumer is a moving target. It's not easy to keep the Nigerian consumer in one place. But having said that, there are 3 trends that we see that are demonstrating the resilience of Nigerian consumers. I'll start with the first one, which is about the adoption of artificial intelligence. It's very interesting to note that the adoption rate of artificial intelligence in Nigeria is higher than the global average. A lot of consumers and businesses are using artificial intelligence for price comparisons, for product search, for engaging at the point of purchase, for copywriting, for creative advertising. Even small indigenous businesses are creating local solutions with the use of artificial intelligence. So this is an opportunity for personalization that we're beginning to see as consumers hold brands more accountable. The second trend that is of great interest is the one that has to do with sustainability. So Nigerian consumers are not just looking at quality and value for money before they buy. They are beginning to ask about how sustainable, how eco-friendly the packaging is of what they are buying. And we've seen some recent initiatives in this direction. Lagos State, for example, is requiring of retail supermarkets to not sell single plastic bags, single-use plastic bags, and rather to replace them with reusable ones. So that shows some interesting trends. So 86% of Nigerian consumers, according to a recent survey, have moved in the direction of buying brands that address social causes that they are interested in. So this presents an opportunity for businesses and markets to rethink the way they produce their products and services, to partner with brands that are more conscious about sustainability.
All right, now let's take a break. When we come back, we do have more stories for you right here on Business Incorporated. Please stay with us. Welcome back. Still watching Business Incorporated here on Channels Television. Let's head to the markets now with Aniti Edeth, even though I don't think it has good news for us. Aniti, I think the market is still persisting in the bearish sentiment area.
Well, the bearish sentiment is still continuing, and of course, it has even gone below the 106,000 points.
Yeah, we lost that. I think we lost that.
Yeah, you talked about that last Friday.
Yeah.
But it's still a hangover of sell pressure. No thanks to the likes of MTN Nigeria and some of the key market bellwethers. So for the intraday market
about MTN, we saw the MTN group results, and it wasn't looking so good, and it does seem like it's all hinged on Nigeria. You know, this is the group, but obviously Nigeria has a major contribution to it, and they say because of the devaluation of the naira, we've seen their results, their revenue drop, and all of that. So I guess we shouldn't be surprised that sell pressure is still on.
Yeah, well, that sell pressure, that report that's actually from the parent company based in South Africa. So, and of course, I would say more that it's a trickle effect of what's happening.
That's one of the reasons they gave.
Okay.
Yes.
I think maybe you might have that information.
Because it's a group. So
exactly.
Nigeria is also, Nigeria's
their biggest market.
Exactly.
Okay.
So that was part of it.
All right. So, but let's talk more about the regional stocks on the continent, the regional stock markets on the continent. We were talking about the domestic stock market. Of course, take a look at that number. Just sometime last week, we were talking about the numbers having to have dropped from 107,000 points to 106,000 points, and barely hanging on that 106,000 points. But lo and behold, from Friday, it fell to 105, losing about 365 billion naira that's in the local currency terms. I don't know, I can't do that calculation in dollar term, which is the de facto world currency. But so far at intraday, the market is down 0.15%, and 105,000 is the I wouldn't call it a psychological number, and I also wouldn't call it a magical number, because that number is receding as we speak, no thanks to the impact of sell pressure. But what the good thing about the market is that at some point, when the prices are lower for some of these stocks, it gives an entry opportunity for those who want to key into some of these stocks, which the prices has moderated due to the impact of sell pressure. So what was high at some point would be reduced. But in terms of the month to date as well as the year to date performance, not too pretty picture for the market. Last time I was on the market analysis, I talked about the market being at about a 3.8%, but now so far it's reduced to about 2.9%. That's year to date. And not a good move, not a good month so far. I also had said, beware the Ides of March. We see that month to date, the market is down by 1.7%. So far, not too pretty picture dwelling on that market. But let's talk about the Johannesburg Stock Exchange, 0.24% intraday in the green, 88,124.06. And for the other markets on the Egyptian Stock Exchange, as well as the Nairobi Stock Exchange, there's kind of a green picture there. For the close of Friday, the Nairobi Stock Exchange all-share index up 0.46%, 129, almost at 130, which it at some time dropped. And then the EGX 30 intraday up 0.36%, 31,451.05. So that's a snapshot for the markets on the markets across the African continent. Now let's talk about what to expect across the markets in Nigeria here, and we're starting off first with the National Bureau of Statistics, which is expected anytime from now to release the February inflation number, which comes shortly after we had that first rebase number, which saw the January inflation number coming lower at about 24.48%. And over the weekend, we had the Central Bank of Nigeria saying that the inflation numbers is expected to moderate. So anytime that the National Bureau of Statistics, if we could have that on the screen there, we'll talk more about that, the National Bureau of Statistics will release that February inflation number anytime from now. So all eyes on that inflation numbers, both the fixed income markets as well as the equities markets will be keying into that number. And still with the financial markets outlook for the week, we expect that there will be a Treasury bills primary market auction where the market is expecting about 800 billion naira worth of new maturities to trickle into the market. And that, of course, will be offsetting about 398, almost 400 billion naira worth of coupon disbursements, which also would have an effect on the overnight rate and would make the overnight rate elevated. Now, for the equities market, which we just talked about, bearish sentiment is expected to continue this week. In the midst of, we had at some point within the month, we've been having a flurry of earnings, which doesn't seem to appeal to the market, and the impact of that has many factors or reasons which is driving that negative sentiment. On one side is the macroeconomic activities within the country, and of course, and at the same time also sell pressure on the side of investors which are investing in the market. And finally, what to expect for the market, which is on the other side, starts from the world's biggest economy, because whatever happens in the US generally affects the whole world. Now that the OECD has already cut the outlook for the country's economy. At the same time, tomorrow, starting from tomorrow, the FOMC, that's the US Fed, which is the country's central bank, will be having the second Fed meeting, its second monetary policy meeting under Donald Trump, who is barely 100 years and still 100 days in office. We're still counting down to that, which will be sometime in the month of April, where he will be complete 100 days in office. But the US Fed is expected to cut the rates, but that outcome of that meeting will be announced on Wednesday. So far, that's a snapshot of what to expect from the US Fed outlook on their rates decision. Now, let's move over to the Middle East, where we see just the UAE stocks, the Dubai index, as well as the Abu Dhabi in the green, 0.6% for the Dubai index, and the Abu Dhabi 0.34% at intraday. Both numbers, both indexes on the United Arab Emirates are doing pretty well. At some point, they weren't doing pretty well, but maybe the impact of bargain hunting from the sides of investors within the Middle Eastern GCC stocks there. Now, let's talk about the other markets within the Middle East. We see Saudi Arabia in the green, but the only laggard there at intraday is the Qatari Stock Exchange, which is down by 0.17% intraday number, and the index is still trading around the 10,400 level, so those numbers are still oscillating back and forth as we speak. And then our next stop is the U.S. markets, where we see the stock futures. We had talked about the U.S. there, but this is ahead of the opening bell. But early today, the stock futures were trading in the red, and the market is still trying to regain some balance after we saw a very brutal week last week for the markets. We saw that the Nasdaq Composite sank deeper into correction territory last week. The S&P 500 briefly dipped into a correction as well, while we saw the Dow Jones also having its biggest one-day drop since 2023. It fell by 4.4%. So this is for the futures opening. But before the opening bell, 2:30 Nigerian time, we expect that the market will still continue in this. But the market investors will be expecting to take a look at some of the upcoming economic data for any signs of economic slowdown. The U.S. retail sales report is set to release later today, and that will give an insight into the state of the consumer. Economist polled by Dow Jones would expect that the retail sales would have increased by 0.6% in February. So that's it, a snapshot for the market, as well as they'll be looking out for that inflation, the interest rate decision by the U.S. Fed. And finally, for the Asian markets, we see that mostly in the green territory, and this is because the markets are all eyeing the data from Chinese stocks there, where we see all the green colors there printing across the Nikkei, the Kospi, the Hang Seng Index, as well as the China Shanghai and India's Nifty 50 for the close of Monday's trading session. So I think it's Asian markets are trying to they've been trying to shake up that the blues from the Trump trade tariff impact.
Yeah, well, everybody's trying to shake that up, and I guess also the talks that we're supposed to have tomorrow between President Donald Trump and President Putin will also shape investor sentiment, and we'll see that reflect in the colors and the numbers in the market.
I just hope the green colors would remain, because I love to see green in as much as red means has another interpretation for some other people who are investors.
All right, Anita, thank you so much.
Pleasure.
All right, now let's look at what the OECD is saying. They said both the United States and global economic growth is set to be lower than previously projected, according to latest estimate from the Organization for Economic Cooperation and Development. Global GDP, they say, is projected to moderate from 3.2% in 2024 to 3.1% in 2025, and then 3.63% in 2026, with higher trade barriers in several G20 economies and increased geopolitical and policy uncertainty weighing on investment and household spending. The OECD said this in their interim economic outlook report. Annual GDP, they say, in the United States projected to slow from its strong recent pace to be 2.2% in 2025 and 1.6% in 2026. In its previous projections published in December, the OECD had estimated 3.3% global economic growth this year, and next, the U.S. economy had been expected to grow 2.4% in 2025 and 2.1% in 2026. The OECD said its latest projections were based on an assumption that bilateral tariffs between Canada and the U.S. and between Mexico and the U.S. are raised by an additional 25 percentage points on almost all merchandise imports from April. If the tariff increases were lower or applied to fewer goods, economic activity would be stronger and inflation would be lower than projected. But global growth would still be weaker than previously expected. This is according to the report. Kenya has requested a new funding program from the International Monetary Fund after agreeing not to proceed with a final review of an existing facility that would have unlocked $800 million. The current $3.6 billion four-year program, signed in the wake of the COVID-19 pandemic that ravaged Kenya's and other economies, ends on April 1. The expiry of the facility without the final disbursement will leave Kenya with a budget financing gap. Kenya needs continued support to keep its economy on track after its debt servicing costs surge due to borrowing spree over the past decades. Ethiopia Airlines Group and the African Development Bank, the FDB, have signed a letter of intent agreeing to establish a partnership to undertake Ethiopia's new international airport development project. The new international airport will have the capacity to handle 100 million passengers a year and will provide parking for 270 aircraft. The mega airport city will rest on a 1.1 million square meter terminal, including extensive passenger and commercial facilities. The new airport is positioned at a lower elevation compared to the current primary hub, Addis Ababa, which is situated at one of the world's most elevated locations and presents unique operational challenges for aircraft. Ethiopia's new international airport expansion project, spearheaded by the state-owned Ethiopian Airlines Group, will address the fast-growing international and domestic demand for passenger and cargo services. A bit of corporate now. MTN Group Limited bid dividend estimate even after Africa's biggest wireless company, by revenue, posted a record loss because of currency devaluations. The Johannesburg-based company said it would pay a dividend of 3.45 Rand a share compared to the 3.35 Rand per share that was the initial forecast. Now let's look at the highlights of this result. We see that data revenue decreased by 12.3% on reported basis, but increased by 21.9% in constant currency. Fintech revenue increased by 11% on a reported basis, but jumped by 28.5% in constant currency. Earnings before interest, tax depreciation and amortization, that's EBITDA, before one-off items decreased by 33.5% on a reported basis, but rose by 10.2% to 70.1 billion Rand in constant currency. EBITDA margin decreased by 8.9% points on a reported basis, but 32% on 0.8 PPT lower. Total subscribers increased by 2.2% to 290.9 million, while active data subscribers rose by 7.7% to 157.8 million. Mobile money monthly active users increased by 0.9% to 63.1%. Let's head to Ghana now and tell you what's happening with the stock exchange. Seems pleasant at this time, at least at the opening. It opened the week on a strong footing with the benchmark, that's the GSE Composite Index, posting a 24.97% year-to-date return, signaling continued investor confidence in the local equities. The GSECL has begun trading at 6,109 points on the GSE Financial Stock Exchange, which tracks financial sector stocks, opened at 2,980 points, reflecting a 25.18 year-to-date gain. Trading activity has remained buoyant last week, with 3.39 million shares changing hands and a total market value of about 9 million Ghana CD. Let's talk about this and a whole lot more. Hope the good news is all over every sector of that economy. We'll find out from the financial and management experts. Mr. Ernest Owusu-Nyako joins us from Accra, Ghana. Thank you so much for joining us, Ernest, and good afternoon.
Thank you so much for having me in here, and have a good afternoon. And let me say Happy New Year to yourself and to
Happy New Year to you too. But so I mean, it seems happy on the stock exchange. Are we in for good days? Is this how it's been? We see gains year to day at the stock exchange.
Yeah. So on the stock exchange, we've actually seen that improvement as you are talking about. But I am not surprised because we saw in the last quarter, third quarter of 2024, the stock exchange recovered so massively. In transactions term, they did 230% year on year. And then that's give us a good signal that there's an increase in investor confidence in the stocks and the economy. So when I saw the performance as reported in recent times, I wasn't surprised. I think what comes to me with the GSE and its performance is that they are doing something good and then which was reflected in the government's economic policy statements last week, when they actually want to position the Ghana Stock Exchange as a profit-making agenda rather than what we currently have. And there are plans to also make this year, they will now start moving from a guarantee base to a public limited company. So seeing this coming through, and surprisingly some investors in there and some stocks which were not doing well at the beginning of the year, 2022, 2023, when Ghana actually go through a lot of economic issues, came back so strong. And that is what we are actually seeing in some kind of stability for the first quarter already. And then just to also relate that to our economic policy statement, which is the budget that was given to us last year. And you also know that we have a new president. He and his team are actually trying to look on that, because we know that our debt stocks, both domestic and foreign, are going beyond bounds. And the minister caps it well to say that we want to only rely on our internal generated funds, specifically the treasury bills, to be able to service all those debts. So going in to have an agenda to service debts and seeing a stock exchange doing so great, it looks like it's a good news to us. We are only anticipating that all other initiatives that the Ghana Stock Exchange have outlined, which includes making it accessible for the customer to be able to trade on the stocks on the phone, which is something we all look out for this year. And also, they also want to get into the space where we can roll out a general credit bureau where people can actually have their credit ratings on their own and understand it. That's put together. I won't be surprised if we should record some much more improvement in the stock market come year end.
So do we see this positive sentiment spread to maybe the fixed income market and other instruments? Do we see this positive instrument, especially when you also look at foreign investments?
Yeah, so the impact we are seeing there surprisingly trickles down to all the other fixed income and all the other funds too. Just that I think the stock markets have taken that bold step, and being the market lead in this investor space would give all other portfolios that are running the leverage to be able to bank on what the Ghana Stock Exchange is doing. Because when we get all that we need as economists or as finance people or as policymakers is to see that there is a positive outlook on our investment portfolios from the general public. If there is a boycott, which I don't anticipate any in the short term, then we can't be singing a different song now. So with the investors doing well, and you also know that when we are looking at the equity traded ones, they normally would have a lot of strings attached to them, which will make it very volatile. The other ones like the mutual funds and all the others, which are heavily regulated, would not have so much risk attached to them. So when the risky ones are doing well, we expect that those that have a balanced form of portfolio would also pick it up and then do exceptionally well. We were surprised to see most companies posting some very good dividend for their investors and shareholders in their finance reports that were shared. The reports are still coming in. I think all of them have up to the end of March to publish. So we sit and wait to see how much dividends are being declared. And we anticipate that half year would give us a much better outlook of what the government policy would interface with their own internal arrangements too.
Well, sounds interesting and good news, but I wonder if this overshadows the fear around, the debt restructuring. For instance, your Minister of Finance had said that the next 4 years, Ghana will have to pay $8.7 billion. That's about 10.9% of the GDP. The biggest will be 2027 and 2028. And we do know that you still have the marks of the debt restructuring from last year.
Yeah. So on the debt restructuring, which we would also want to include the domestic exchange program that was rolled out from 2022. We had 3 phases of it, which was too much a hit for citizens and the country to take. And looking at that 8.7, that is the foreign debt stock. When you look at the domestic one, we have 150 billion Ghana cedis to think about. Already, we have exhausted all the ceilings. So we've actually have treasury bills as the only option, which the finance minister stated so clearly in his policy statement. What is happening to the economy that gives us a bit more confidence is the fact that consistently from the beginning of the year, the government and the central bank have exceeded their auctions when it comes to their treasury bill. The last one that was held over the week, I saw some 6.22% increase over subscription. Now, when we get into that space, then what this government and its policymakers have successfully done is to reduce the rate on treasury bills from the 20% and 22% that we had some years back to an average of between 15 and 18%. So when we consistently will have that, then it means that the cost of debt to the government, to the domestic market is reducing, whilst the citizens and investors still have confidence in the fact that the government will deliver. And so we hope to see more of these oversubscriptions.
But because, I mean, it's a normal thing. When the yields or the rates are reduced, then, I mean, isn't that a disincentive or discouragement to investors, you know, to come into the market?
Okay, so ideally, and from theory, that is what should have happened. But for the past 3 years, when we saw those increments in rates as an incentive to get us to bring more cash, we realized that was not organic. So in some 18 months past, we were getting 24, 25, 26% on treasury bill rates because the government had gone into a domestic debt exchange and bondholders were not getting their monies and had to go through that restructuring, like you understand, and pushing people's monies and capitals into 15 years from the time they were expecting it was a big disincentive to the economy. And we were actually not getting the government to have a full subscription on treasury bills, which technically is a 0% rated in terms of risks. But then when we had to see what we are dealing with, that look, this is what we have to face, and we had a lot of demonstrations all over the place. Now, when you reduce it to 18 and 15, now we appreciate it as this is the reality, this is what we want. If you are giving me 25, 24% and I stand the risk of not getting it when it is due, then that becomes a turn-off. We wouldn't come, and that explains why the government was not getting the full subscriptions in the last 18 and 15 months. But when the rates came down, now we have an appreciation of the fact that this is transparency, this is reality. So we would want to go in there. And again, what actually is increasing the subscription is the fact that the debts restructuring that happened around bondholders have not been reversed. So they are getting to see their payments happen when the time is due. So then it gives those who are not actually going into the bond structure the leverage and the comfort that if I should place my funds with the government, like I would explain to the layman, in the next 3 months, I'm sure to get the rate, even though small, but I have confidence in that. So that is the only explanation we can put through the oversubscription and the reduction of the rate.
And I guess most of the investors now are Ghanaians, right?
Yes, most of them are Ghanaians. The foreign investors, in the past, I think we had about some of them leaving the economy because of some of all of these things. But the ones that were partially owned, we are still having them, but largely are Ghanaian investors and largely retail investors, which contribute mostly to these Uber subscriptions.
All right, I know that when President Mahama was coming in, he did talk about, you know, how he was going to reduce taxes, which would be against some of the agreement that Ghana already had with IMF I wonder how that is playing out.
So I was also in anticipation like yourself, but last week when the budget statement was read, we saw some very bold decisions in there. What the government is focusing now is that, yes, those taxes have been revoked or abolished, as we would normally want to call it. There were lots of revocation. The 10% withholding tax on lottery winnings, and we probably call it the betting tax, has been abolished. The infamous e-levy, which was the taxes on electronic transactions, have also been cited to be abolished. We have emission tax, which comes up when you have a high emission equipment like a vehicle that's emits a lot of into the environment, also has been abolished. And then when it came to the COVID-related tax, those ones were wind into the structure of the VAT. So the government has asked that the World Bank helps give policy advice in how to take that one out. Now, my question to the government was, how are you going to get the difference in the shortfall? Already, what was coming into the health sector and other non-governmental organizations by way of USAID has been revoked for some time now. So what the government was doing is now cutting down some spendings. And typical among them, the government mentions that to be able to meet some of those debts, funds that are supposed to be used for payments of contracts and procurement mandates are going to be audited. So the government talks about having a whole payroll audit for the public service, and then having a review of all contracts that are due to understand those that are genuinely due to be paid. Aside that, the government has also cut some spending in the exports. And then, if you can recall, the government or the President Mahama is talking about getting some agricultural growth in the space of, for instance, poultry, where the government cites that, look, for some time now we've been importing so much, so we cut that one. Believing the government to be able to cut some of those spendings, already the government has been sized into half compared to the previous administration for now. If all these ones are coming through, and to say that, look, we can still rake in a lot from what we have, and not to forget that the labor union also agreed to a 10% increment, which was not what was expected, that they would do a 10%, because normally they would have pegged it against the current rate of inflation, which hovers around the 20s. Now, they say they want a 10%, which gives the government some more room to be able to use that anticipated increase in public sector salaries. That can also help. Then again, the government cuts down its administrators and government by almost a half. That is going to help. And then the only increments that we are also seeing, and also he has also revoked some tax exemptions that were given to some organizations and some people, especially in the ceramic industry. All of that is what we believe, if it is heeded to judiciously, would be able to cover up those gaps. Again, we have the next phase of the IMF review coming up ahead. So that is going to be able to inform us whether we'll be able to meet the IMF conditionalities with respect to revenue mobilization. And also, another thing that is going to give the government room to breathe is that some projects that were initiated by the previous government have been put on hold. For instance, the government talks about agenda, the 1D1F, which was to say that every district will have a factory. The government says we already have municipal district authorities or assemblies, let them handle that. The government is saying that we as a government are not going to focus so much on putting up factories across all the over 275 districts. Let's get the private sector involved in that. So that doesn't become a government initiative again. So it will go off the government's book. Then you have initiatives that were supposed to bring stability after COVID. The government says COVID has been gone for years now, and we still cannot be referring to COVID as the reason for our predicament. So all those initiatives which seek to put a drag on our budget and our physical mandates as an economy would now be taken away. Now it leaves us to our fate to be able to run from March to June and see how this plays out. If the government gives us an analysis and tells us that the e-levy was not so much a backbone for the economy, so taking it off is fine. Okay. Then that is okay, and all the other taxes.
Well, I guess that President Mahama had it all figured out before he made that promise, you know, and well, let's see, as you said, how much of those leakages will be plugged and how it will be redirected. Thank you.
Exactly. We like the energy that has come. I only anticipate it to be one that would continue. And you know where we find ourselves in the world. You shouldn't be too excited about some of these things.
Okay, so let's be cautious. Let's be cautiously optimistic. Exactly. Thank you so much, Ernest.
The Ghanaian economy to always ask the questions as and when they feel it is necessary.
All right, Ernest Umusu-Nwako, a financial and management expert in Accra, Ghana. Thank you so much for giving us so much details of what's going on in the economy there.
Thank you, Ini.
All right, now let's head straight to Berlin. 3 weeks after the election, Germany is heading a step closer to having a new government, and the election-winning Christian Democrats and the Social Democrats have agreed on a debt and budget plan. We talked about the government planning to raise the ceiling to allow for more spending. Lars Holter joins us now to tell us if this has been agreed. Hi, Lars. Good to have you back. So has the ceiling been broken or just raised?
Yes, hello, Ini, and thanks for having me. It has been quite a weekend here in Berlin. News actually came last Friday that a significant progress had been made in coalition talks. But let's just backtrack a bit here. The election in Germany happened on the same weekend, as you remember, then U.S. President Trump's disastrous meeting with Ukraine's Volodymyr Zelensky in Washington. And so immediately after the elections, politicians here realized that they were dealing with a new reality, including the need to spend a lot more on defense than really ever before. So election winner Friedrich Merz of the conservative Christian Democrats Party pulled a quick 180 and suggested to take on billions in new debt to invest in the military. To get a future coalition partner, the Social Democrats, on board, they also threw in another couple of $100 billion for infrastructure. But taking on this level of debt needs an amendment to the constitutionally enshrined debt brake. I do remember we've discussed it before, so there was quite a problem here. Now the parties figured it would be easier to actually ram it through the old parliament before establishing the new government. That's because the new government after the election would likely not have been able to get enough votes for such a plan. Now they just needed support of the Green Party, and after shorter talks than anyone really could have imagined, they actually got them on board.
So what did it take to get them on board?
Well, you know, the Green Party had long been vehemently against more debt for financing the military, but here's one factor that played into this. I guess they too knew, of course, when something is really necessary, it just needs to be done. They were also angry after the coalition parties had kept them sidelined for a while, but I guess in the end, yeah, they just found exactly what the Green Party was looking for. First of all, they wrote in the constitutional amendment that all those billions in new debt can only be accessed after 10% of the country's regular budget has been spent on investments in infrastructure. And they've also made sure that 100 billion euros out of a total of 500 billion euros, so just about 20% here, will be spent on the existing initiative on a Green New Deal style refurbishment of the German economy. Now, that is money that will go into projects fighting climate change. It will go into subsidizing incentivizing sustainable energy. It will help build up wind and solar and generally get Germany closer to its long-agreed climate goals. And that is exactly something the Greens needed. And now they got something to show for, something that justifies their support for a budget policy they would have otherwise not been backing.
Yeah, well, I guess sometimes opposition parties have common ground. But what are investors making of all of this?
Well, first of all, investors are pretty happy about these developments. That's for sure. Same, by the way, is true for news coming out of the U.S. just hours after these developments here, where Congress, of course, has also avoided a government shutdown. Looks like very similar issues for world markets. And now, this all happened, however, on Friday, if late, of course. And while markets ended last week on a strong note, they are doing a bit weaker now this Monday. For Germany, when we're looking at Frankfurt, there is some doubt, I want to say at least a little bit of doubt, about whether this deal that I just described is actually now going through, or if there might be more hurdles coming. So we're seeing a little bit of insecurity. And, you know, if there were more problems, that would, of course, be bad news, mostly for defense companies who are relying on this new military spending. They had quite a run based on the up military spending. So today, or actually right now, I would say we're seeing the DAX in Frankfurt up just a tad, just fractions, but generally markets are a bit unsure, so we'll be keeping an eye on how it's going to move from here.
Yeah, we'll certainly keep an eye there. Lars, thank you so much for those details.
You're welcome. Thank you, Ini.
All right, let's head to the crypto space with Ladi. And I had an elaborate conversation with the financial experts in Ghana, and it does seem like President Mahama has some very new ideas. We don't know, I mean...
Yeah, it's all about Solana.
Yeah.
It's endorsing Solana.
Yes.
We see the platform.
Yeah, I mean, out of nowhere, Ghana is endorsing a cryptocurrency.
Yeah.
I wonder how that
Things are happening, countries and cryptocurrency. But let's breeze through. We see the Bank of Korea there. They're saying they're not going to hold Bitcoin as a reserve fund. They said it doesn't meet the nation's or the International Monetary Fund's standards. That's one of the top stories in the market. We're also seeing BNB Chain overtaking Solana at this point. So much playing out right there in the market. But let's bring in Olumide Additional now to see what's playing out. Hello, Olumide.
Good afternoon. Thanks for having me.
Good afternoon, Olumide. So we're seeing some top news there. A crypto whale is betting that Bitcoin and most of cryptocurrencies will drop. He's shorting about $300 million now with a 40x leverage. What is he seeing?
Well, I don't know what he's seeing, but what the market is actually seeing is a moderated exposure in the asset class, and that's primarily because the U.S. trade tariffs, Donald Trump's endless tweets that are shaking the global market has really kept risky assets like Bitcoin and the crypto market on the downward momentum. Waking up today, looking at the U.S. futures, that tells you that we're likely going to see red in the crypto market because there's a positive correlation between U.S. stocks and the crypto market. And Ladi, you know, the Fed meeting this week definitely would add some volatility. But the reality is that while we saw recovery on Friday, the truth is that the fundamentals still remain. Like I said earlier, trade tariffs really unsettled the market. Solana's governance proposal was kind of rejected, which gave Solana some kind of upside. You look at the Bybit ARC, the rumor that most of the coins Ethereum stolen now has been converted to Bitcoin. That also has really changed the dynamics in the market because now the North Koreans now have more Bitcoin than El Salvador and countries like Buhatin that really bought it together. So people are arguing that will crypto really meet the deflationary properties, which gold is going at all-time high, while Bitcoin looks like it's closer to 75,000 support level. So now the debate is on, but the truth is that the crypto market is really suffering from liquidity inflows and also the fact that investors really are not looking at that market.
Right, and even though they're not looking, we're seeing green on the screen at this point. But with all you've mentioned now, with the tariff wars and gold hitting the $3,000 level, is it time to just exit risk assets?
Well, you can't I think Bitcoin has shown that it's a traditional asset now. BlackRock behind it with about $52 billion MicroStrategy. Few institutional investors are also supporting the asset class. But the reality is that investors are worried that when the market has high uncertainty, this asset class drops. You look at Ethereum, it looks like it can't hold the 1,900 support level. So while the market looks green, like you said, I think it's more like pale green, because if you look at the fear index, it's still around 22, telling you that investors are not really, the confidence level is not as high as you think it is. So for me, I would say that stick with the asset classes that show inflows, and also reduce your exposure in risky assets, because I think the worst is not yet over.
Right. Thank you so much, Olumide Adesina, for bringing us up to speed on what's playing out in those markets. So, according to Olumide, the worst is not over, and definitely investors are trying to maybe find some kind of hedge, at this point. But the first quarter is almost over, at this point. We're looking out for Q2 now.
Yes, we're looking out of Q2. I think less than 2 weeks, we're out of the first quarter. Yeah. And it's been a very turbulent first quarter, I must say.
Yes, that is the word.
Very turbulent. Well, let's hope that the second quarter will be better.
Right.
Depending on President Donald Trump.
All eyes on Trump.
All right, so that's it on the program. Thank you so much for being a part of Business Incorporated today. Remember, this happens every weekday. There's 10 a.m. and then there's 1 p.m. So we'll start again tomorrow. So tomorrow I'll see you first, I think, 10 a.m. for the global news. But Ladi will be back news for the 10 p.m.